If interest rates drop in 2026, do REITs automatically win? That is a question a lot of income investors are asking. And at first, the answer seems obvious. Lower rates should help real estate. Lower rates should help dividend stocks. Lower rates should help REITs. But the real answer is more complicated. Lower rates can help REITs. They can improve valuations. They can reduce pressure on debt. They can make REIT dividends look more attractive compared to bonds and money market funds. But lower rates do not fix every REIT. They do not fix weak occupancy. They do not fix bad balance sheets. They do not fix uncovered dividends. And they do not fix a broken business model. So in this video, we're going to look at how REITs actually perform when interest rates drop. Not just the simple bullish version, but the real version. Lower rates can help REITs, but they do not fix every REIT. To understand why, we first need to understand why interest rates matter so much for REITs in the first place. REITs are real estate businesses, but they are also capital allocation machines. That means interest rates matter a lot. Rates affect the cost of debt. They affect valuations. They affect dividend yield competition. They affect cap rates. They affect refinancing. They affect acquisitions. And they affect development. A REIT usually needs capital to grow. It may use debt to buy properties. It may refinance older debt. It may develop new projects. It may issue equity. And it may compete with other income assets for investor attention. When money becomes more expensive, growth can become harder. When money becomes cheaper, growth may become easier. But this does not happen equally for every REIT. A REIT with a strong balance sheet may benefit more. A REIT with weak debt structure may still struggle. A REIT with real demand may grow. A REIT with weak demand may simply get a temporary valuation boost. REITs are real estate businesses, but they are also capital allocation machines. Now let's place that idea inside the 2026 setup. In 2026, the setup for REITs is not just about interest rates. It is about interest rates plus fundamentals. On June 17, 2026, the Fed held the federal funds rate at 3.50% to 3.75%. That means rates were still meaningful, not zero, not extremely low, but lower than the peak environment many investors had been worried about. At the same time, REIT fundamentals showed signs of improvement. REIT reported FFO growth of 14.8% year over year. NOI grew 5.6% year over year. Same-store NOI grew 3.8%. Occupancy for equity REITs was 93.2%. Debt-to-market assets was 35.4%, and the weighted average term to maturity of REIT debt was 5.9 years. That matters because REITs do not only need lower rates, they need cash flow, occupancy, balance sheet strength, and real property demand. The setup is not just about rates, it is about rates plus fundamentals. Now let's break down the first way lower rates can help REITs: valuation. The first channel is valuation. When interest rates fall, discount rates may fall too. And when discount rates fall, investors may be willing to pay higher prices for future cash flows. That can help REIT valuations. It can also make REIT dividend yields look more attractive. If bonds and money market funds are paying less, investors may start looking again at real estate income. That can support multiple expansion. In simple terms, the market may reprice REITs higher if investors believe lower rates improve the outlook. But there is a catch. Starting valuation still matters. If a REIT is already expensive, a rate cut may not leave much upside. If a REIT has weak fundamentals, a lower discount rate may not be enough. And if the market already expected the rate cut, the good news may already be priced in. A rate cut can lift valuations, but overpaying can still ruin returns. So valuation is important, but it is only one channel. The second channel is debt cost. The second channel is debt cost. This is one of the biggest reasons REIT investors care about interest rates. REITs use debt to acquire properties. They use debt to refinance maturities.
They use debt to develop projects, and they use capital markets to fund growth. When rates fall, refinancing pressure may ease. Interest expense can become less painful, and the cost of capital can improve. That can make acquisitions and development more attractive. But again, not every REIT benefits at the same speed. It depends on the balance sheet. Does the REIT have a lot of debt maturing soon? Is the debt fixed or variable? What is the credit rating? Can the company access capital on good terms? A REIT with mostly fixed-rate debt and long maturities may not see an immediate benefit. A REIT with near-term refinancing needs may feel rate changes more directly. And a weaker REIT may still pay a higher spread even when base rates fall. Lower rates help most when the balance sheet is ready to benefit. Now let's move from debt markets to property values.
The third channel is cap rates and property values. Cap rates and interest rates are connected, but they are not the same thing. When interest rates fall, property values can get support because the required return on real estate may decline. That can help REIT net asset values. It can also bring more buyers and sellers back into the market. Transactions may become easier, acquisitions may become more attractive, and private real estate values may start adjusting. But there is usually a timing difference. Publicly traded REITs can move quickly. Private real estate prices can adjust more slowly. That is why publicly traded REITs often move before private real estate prices fully adjust to the new rate environment. But lower rates do not guarantee higher property values. If rents are weakening, occupancy is falling, or cap rates stay elevated because investors demand more risk premium, the benefit can be limited. Public REITs often move before private real estate prices fully adjust. And the fourth channel is especially important for income investors: dividend yield competition. The fourth channel is dividend yield competition. REITs compete for investor money against Treasuries, bonds, money market funds, CDs, dividend stocks, and other income assets. When fixed income yields are high, many investors ask a simple question: why take REIT risk if I can get attractive income from safer assets? But when fixed income yields fall, the comparison can change. REIT dividends may start looking more attractive again. That can bring income-focused investors back into the sector. But there is a major warning here. A high REIT dividend is not automatically a good REIT dividend. Dividend quality depends on cash flow. It depends on AFFO. It depends on payout ratio. It depends on the balance sheet. It depends on tenant demand, and it depends on whether the dividend is actually sustainable. A REIT dividend becomes more attractive only if the cash flow behind it is healthy. Now let's talk about the good version of rate cuts for REITs. Rate cuts are usually best for REITs when they happen for the right reason. The ideal setup is lower rates plus a healthy economy. Inflation slows, economic growth continues, occupancy holds up, NOI keeps growing, credit conditions improve, and cap rates stabilize. In that environment, REITs can benefit from rate relief without seeing their property fundamentals collapse. That is the best-case scenario. Valuations can improve, debt pressure can ease, transactions can return, development can become more attractive, and income investors may look at REIT dividends more favorably. But the key is that fundamentals need to stay healthy. Lower rates by themselves are not enough. If the economy is still working, lower rates can support REITs. If tenants are still paying rent, lower rates can support REITs. If occupancy remains healthy, lower rates can support REITs. The best case for REITs is not just lower rates. It is lower rates without a broken economy. But sometimes rate cuts happen for the wrong reason. Rate cuts can disappoint REIT investors when they happen, because growth is breaking. That is the risk many investors forget. If the Fed cuts because inflation is cooling and the economy is stable, that can be positive. But if the Fed cuts because the economy is weakening, the story changes. Unemployment may rise, consumers may pull back, companies may reduce space, retail tenants may struggle, office tenants may downsize, defaults may increase, and occupancy may fall. In that environment, lower rates may help valuations, but weaker fundamentals can hurt cash flow. That is why not every rate cut is automatically bullish. Investors have to ask why rates are falling.
Are rates falling because inflation is under control, or are rates falling because the economy is deteriorating? Those are two very different stories. If rates fall because growth is breaking, REITs may not get the rally investors expect. Now let's look at which REIT sectors may benefit more if the rate cut setup is healthy. If rates fall and fundamentals remain healthy, some REIT sectors may be better positioned than others. Net lease REITs can benefit because their long-duration cash flows may become more attractive when rates decline. Apartment REITs may benefit if financing improves and housing demand remains resilient. Quality retail REITs can benefit if consumer spending holds up and tenants remain healthy. Industrial REITs can benefit if logistics demand stays strong and lower capital costs support growth. Data center REITs can benefit if they still have access to capital for large development needs. But the sector label is not enough. The best REITs in a falling rate cycle are usually the ones with both balance sheet strength and real tenant demand. That combination matters. A REIT with strong demand but too much debt may struggle. A REIT with a clean balance sheet but weak property demand may not compound well. A REIT with a great dividend but poor coverage may disappoint. The winning formula is usually sector quality, balance sheet strength, and real tenant demand. Now that we have covered the main upside, this is a good point for a quick channel pause. This is the kind of REIT analysis we focus on at Boring Money Wins. Not just saying rate cuts are good, not just chasing dividend yield, and not just assuming every REIT will recover at the same time. The goal is to separate rate cut excitement from real fundamentals: cash flow, valuation, dividends, balance sheets, debt maturities, occupancy, and sector demand. If you like no-hype REIT analysis that explains both the upside and the risk, hit the like button and subscribe to the channel. It helps the channel grow, and it tells YouTube to show more practical investing content to people who want long-term investing without the noise. Now let's look at the other side. Which REITs may still lag even if rates drop? Lower rates can help the math, but they cannot fix a broken business model. Some REITs may still lag even in a falling rate environment. REITs with weak occupancy can struggle. REITs with excessive debt can struggle. REITs with uncovered dividends can struggle. REITs in sectors with weak structural demand can struggle. Troubled office REITs may still face serious pressure if tenants keep reducing space. And REITs that are already too expensive may disappoint even if the business is good. This is why investors need to be careful. A lower interest rate environment can make a bad REIT look more tempting. The stock may bounce. The dividend may look attractive. The valuation may appear cheaper than before. But if the underlying business is weak, the long-term thesis may still be broken. Rate relief is not a business plan. Lower rates can help the math, but they cannot fix a broken business model. So before buying the rate cut story, investors need a checklist. When rates fall, do not start with the headline. Start with the numbers. Is AFFO growing? Is NOI growing? Is occupancy healthy? When does the debt mature? Is the debt mostly fixed or variable? Is the dividend payout sustainable? Does the valuation already price in rate cuts? And does the sector have real demand? Those questions matter more than the macro story. A REIT can benefit from lower rates and still be a bad investment if the fundamentals are weak. A REIT can have a high dividend and still be risky if the payout is not covered. A REIT can have a great sector story and still disappoint if the valuation is too expensive. The checklist keeps investors grounded. It forces the analysis back to cash flow, debt, demand, and valuation. Do not buy the rate cut story until the REIT numbers support it. And once you have that checklist, the next step is knowing how to invest without betting everything on one macro outcome. A rate cut thesis should support your REIT investment. It should not replace your analysis. One approach is using a diversified REIT ETF. That reduces single company risk, although it still carries sector and market risk. Another approach is choosing sector leaders with stronger balance sheets, better demand, and covered dividends. Investors can also diversify across REIT sectors: net lease, industrial, apartments, retail, data centers, healthcare. The goal is not to bet everything on one outcome. It is to build exposure that can survive different environments. Investors should also avoid yield traps, limit position size when valuation becomes aggressive, and track quarterly fundamentals. The biggest mistake is buying only because a REIT fell, or buying only because the dividend looks high, or buying only because the Fed may cut. A rate cut thesis should support your REIT investment, not replace your analysis. Now let's bring everything together into the final verdict. So, how do REITs perform when interest rates drop? The answer is that lower rates can help. They can improve valuation potential. They can lower the cost of capital. They can make REIT dividends look more attractive. And they can ease refinancing pressure. But fundamentals still matter. The reason for the rate cuts matters. That matters. Sector quality matters. Valuation matters. And cash flow matters. Strong REITs may benefit more because lower rates give them a better environment to grow, refinance, acquire, and prove their business model. Weak REITs may stay weak because lower rates cannot fix poor occupancy, bad debt structure, weak demand, or uncovered dividends. That is the balanced answer. When rates drop, the best REITs do not just get cheaper money. They get a better chance to prove their business model. And boring money usually wins because boring money usually survives.